Good morning, students. This is one more lecture in the series of the lectures for national income and related aggregates. Today we are going to start up with the value of output versus value added. What is value of output and what is value added? And after that we'll do one more small topic that is called a GDP deflator. And then we will start up with the measurements of national income. You have got three measurements of national income. We'll do them one by one. So for a time being, in this very lecture, we'll talk about what is value of output and what do we mean by value added. So as far as this value of output and value of added, there are two distinct words. One is output and other is added. How we differentiate between the two? When we define value of goods and services, we take the value of goods and services produced in an economy. That is what we do in national income. We calculate whatsoever is produced in an economy and whatsoever is transacted in an economy. So when we talk of value of output, value of output is something which could be defined as the market value. See, when I say value of output, this value of output is defined as the market value of goods and services produced by an enterprise during an accounting year. So see, you must keep in mind that value of output means value of gross output at market price, unless stated otherwise. What is that? When we say value of output, we have taken into consideration this word output. This is what is making to go. This is what will make a difference in between the two. See, a quantity of goods and services is being sold in the market, and for that quantity commands a price. When we multiply the two, we get the value of output. So that means if we put it in a formula, it will be like value of output is equal to quantity, a particular quantity of output, and the price it commands, multiply by the price. So we see that this is the quantity and the price. This is the Q and the P, which are giving us the value of the output. Suppose there is a shoemaker or a shoemaking enterprise. The shoemaking enterprise produces 1,000 pairs of shoes annually per annum. They are producing 1,000 pairs of shoes per annum, and they sell them. That means this is our quantity now, and they sell them at a price. It is obvious. Let us say they sell them at a price of 175 rupees, 175 per pair. So this is the total production, 1,000 pairs per annum, and this is the price per pair. They have produced 1,000 pairs. So if we will look into what will be the value of output, that will simply be equal to this 1,000, that is quantity, multiplied by the price per unit, that will come equal to 175,000. This 175,000 is the value of output for this very particular enterprise which is producing shoes. Alternatively, we can talk in one more sense where we can say that value of output. Now, value of output, if we are talking in the above context, our value of output is equal to sales, okay, plus change in stock. Change in stock. See, whatsoever is produced annually, it is not obvious that all will be sold. Some is accumulated as well. So alternatively, this could be one more type of formula or one more way of understanding the value of output. So we can say it can be expressed as the sum of sales and change in stock. Change in stock, because output is either sold or it is accumulated. Either it is sold or it remains behind for the next year or whatsoever. So this is one more way. So we have got here now two formulas to calculate value of output. Contrary to it, when we talk about the one more concept here, that is value added. This is something, it refers to the, let us write it, it refers to addition or to the addition of value to the raw material. Now, we are adding some value to the raw material. What is raw material? It could be also called as intermediate goods by a firm. This is something which is added by a firm by virtue of its productive assets or activities. So value added is referring to the addition, this addition of a value made or given to the raw materials. That means a particular person is buying some raw materials from the market. In case of our previous example, the shoemaker, this shoemaker has to buy many things. He has to buy for his production, he has to buy let us say leather, okay, nails, polish, thread, etc., etc. He has to buy all these very things. These are his raw materials. Now, when he will put it in his production process, and by his productive activities, this productive activity what we were talking about, by his productive activities, he will turn all that into shoes, and we will buy a pair of shoes. What we bought it at 175 rupees per pair, and he had produced in total 1000 pair for a year. So that simply means that this enterprise is adding a value. This is adding some value to the raw materials, and that is what is the main difference or main definition of value of output and value added. So in order to understand this value added, and we can talk in one more way, then we will proceed to an example, or I'll convert it into a flow chart where you will be able to understand properly what I am talking about. So if we say in one more way from the previous lectures, we can say value added is equal to value of output. Now you all know what is value of output. Total value of output minus intermediate consumption. What is intermediate consumption? This all is intermediate consumption, raw materials, etc. and etc. intermediate consumption. Now, if it is getting a bit of confusing for you people, this all could be converted into a very beautiful process or into a very beautiful thing that I may be able to convert it into, for you people, into let us say a flow chart. We'll make a flow chart. That flow chart will make you people to understand what we are talking about. For that flow chart, we will take both the two things together. That is output and value added. That is value of output and value added. These two things could be taken together. So let us first bifurcate it into two. First is value of output of a production unit. Second is value added by a production unit. Please listen properly what I am saying. It is value of output of a production unit and value added by a production unit. So this value of output of a production unit is equal to sales plus closing stock minus opening stock. And this closing stock minus opening stock is basically the change in stock, what we are talking about. And this value added could further be, I'll change the color for you people to make you understand it better. This value of a production unit is basically, I'll put it like this. It is basically gross value added at market price. You know what is this gross value added at market price from the previous classes, which is equal to value of output minus intermediate consumption. Okay. Second thing is net value added at market price. Now you also know how to convert gross value added into net value added, which would be equal to, now I'll take gross value added, because gross value added is equal to value of output minus intermediate consumption. Intermediate consumption means that raw materials, etc., which we were using. So gross value added at market price minus depreciation. Depreciation is also called as consumption of fixed capital. And next thing is net value added at factor cost. Now you can also convert net value added into market price into net value added into factor cost at factor cost, which is equal to net value added at this market price, which we just talked about, and minus net indirect taxes. So net indirect taxes, when we talk of this net value added at factor cost, bear it in mind, it can be further put in one more step or in one more process, where we can extend it like, I'll extend it like from here, I'll extend it like wage, rent, interest, and profit. What is it all? It is a value added by a production unit. In a production unit, they use factors of production, and that factors of production are to be paid, and that factors of production are paid with what we term here as wages, rent, interest, profit. Wages are for exactly labor. Rent is for Wages are for labor, rent is for land, interest is for the capital, and yes, of course, it is indicated by K written with C. Capital and profit for the organization or enterprise or entrepreneurship. So this flowchart is now explaining us how these things are getting bifurcated. For further explanation of this very concept, we can move to a sort of simple numerical type example, which will make us understand that how actually or how basically this all works and how it all happens. What is the value of output, what is intermediate consumption, and what is value added, how value is added. And this is going to answer a few more important questions of ours. Now let us, for you people, let us take an example of a farmer, of a wheat producing farmer. So let us say we have got a production unit. I'll just underline it whole first. Okay, we have got a production unit. Whatsoever is our production unit. Okay. Second thing we will talk about will be our value of output. We can subtract intermediate consumption, or we can even make it a separate column. And at last we will see what is value added. So here let us bifurcate this second column into two for you people, so that you may understand it properly properly what I am talking about. Suppose we have a farmer. This farmer produced some wheat worth rupees 1000. And for this very example, suppose this farmer has given no inputs. He has used no inputs. Everything was with him only. So there is no intermediate consumption. We will put it as 0. So if we would see in an economy, this farmer has added a value of rupees 1000. Second thing, let us say this farmer is now obviously going to sell out this wheat to a miller. A miller will process with it. So this miller bought raw material from the farmer worth rupees 1000, because it is going to be his intermediate consumption. Now he processed with it, he worked with it, and he turned it into a flour, packed it into bags, send it to different markets, so on and so forth. So let us say that he is selling this whole wheat, this now wheat turned into flour, for rupees 2000. So if we would see, the value of output here is rupees 2000 now by the miller. It is his total output, and his intermediate consumption is rupees 1000. That means the value of output minus intermediate consumption will give us value added. So he also added a value of rupees 1000 in an economy. Third thing we are talking about here is this miller is going to sell out this flour, let us say, to a baker. And this baker bought this flour for rupees 2000. It is his intermediate consumption now, his raw material now, with which he is going to process and turn it into bread, cookies, and so on and so forth, cakes, etc. So what he would do, he would process with it. Let us say he processed with it and he turned it into the confectionery or bakery worth rupees 2200. So again, the value of output minus intermediate consumption will be 200 rupees here. So this is the value added by a baker. This 1000 is value added by this farmer. This 1000 is again value added by this miller. This 200 is value added by this baker. Now we can say that there is a process taking place in this very economy. So let us make a total of all this what has happened. If we total this 1000 plus 2000 is 3000 plus 2000 is 5000 plus 200 is 5200 rupees. Let us say it is 52,000, it is 52 crores, it is whatsoever. It is happening in an economy. So here intermediate consumption is worth 3000. If we would again subtract the 5200 with 3000 rupees, we will be left off with 2200 rupees. So the total value of output in an economy is equal to 5200 rupees. The total intermediate consumption by all the producing units is 3000 rupees. And we subtract by the two, the total value added in an economy here is 2200 rupees. So by the virtue of this very example, we are here to able to understand that what does it basically mean and how does it all basically operates. So here you are now able to understand the real distinction in between what is called the value of output and what is value added. So value of output is the market value of goods and services produced by an enterprise during an accounting year, which is equal to the quantity of output into price. It could be termed as value of output also is equal to sales plus change in stock. And this is sum of sold and change in stock. Okay, this is value added. And after value added, we were able to bifurcate all these very things. What I said earlier is the change in stock. The change in stock is equal to closing stock minus here closing stock minus opening stock. Sales plus change in stock or closing stock minus opening stock will be equal to value of output, which will in turn be value added by a production unit. So here we are able to understand it, how it gets divided into how factors of production are getting paid. So ultimately, by the help of this very particular table, we were able to make it happen in an actual economy, that how it happens and all. So dear students, here this was the concept which you would need really very much in the coming lectures. Now let us talk of one more important thing, which is called as the GDP deflator. GDP deflator. So this GDP deflator is an important tool which we require in an economy. This is a tool which will measure the average level of prices of all goods and services that makes up that make up GDP basically. So if we have to define it, this GDP deflator, how we would define it? So GDP deflator is a tool which measures the average level of prices of all goods and services that make up GDP. So it is calculated, when you calculate this GDP deflator, it is calculated as the ratio. And when we talk of as the ratio means where we divide something with anything else. Okay, so when I say it is calculated as the ratio, it is the ratio in between of nominal GDP to real GDP. So I am here taking two names. One is nominal GDP and other is real GDP. So from the previous lecture you must be remembering that nominal GDP is calculated on the basis of present prices which are prevailing in the market, while real GDP is calculated on the basis of the base year prices or the previous year prices. So nominal GDP and real GDP, when it is put in a ratio, when the ratio of it is calculated, we will get GDP deflator. So the formula will turn like GDP deflator. That is what we are going to, it is deflator is equal to nominal GDP divide by real GDP. I'll have to rub a bit here. Okay, real GDP multiply by 100. So GDP deflator is nominal GDP by real GDP multiply by 100. For an instance, if a nominal GDP through expenditure, let me take expenditure approach, because you people do not know what I am saying when I am saying this expenditure approach, because we have to do the measurements of national income, and measurements of national income are done three ways: product method or a value added method, this expenditure method, and an income method. So for a time being I am taking one of the methods that you will learn shortly what it is. So GDP deflator, if for instance I am taking through, I'll write it here, through expenditure. This is the total expenditure made in an economy by every participant of the economy by expenditure approach. So dear students, please look here what I am saying. So I am going to calculate GDP deflator through expenditure approach. So expenditure is obviously which is equal to the quantity of good into price. That's what we were talking about in value added net value of output. Let us say through expenditure approach it is the GDP through expenditure approach comes equal to 21,000 crores. Okay, I'll put a hashtag here, 21,000 crores. And real GDP, that is, real GDP means the GDP calculated on the previous year price basis or base year prices, is, let us say, rupees 20,000. So there is a difference of rupees 1,000 in the previous year price and this year price, crore. Okay, so GDP deflator will be equal to GDP deflator will be equal to nominal GDP upon real GDP multiply by 100, because we have to talk of the ratio, which will in turn be equal to nominal GDP is how much? Nominal GDP is how much? Exactly this 21,000 divided by real GDP, which is equal to 20,000 multiply by 100, which will be equal to 100, which will be equal to okay, this will be equal to 105. So you can see that what we calculated is GDP deflator. The value of GDP deflator turned to be 105. Now this GDP deflator is a tool, as I said earlier, in order to neutralize the effect of rise in prices, because it won't tell us if the prices have been rising in the year. It won't tell us that what actually the nation has done, or what has the productivity wise where the nation is. So to neutralize the effect of rise in prices, we convert nominal GDP into real GDP. with the help of GDP deflator. So this is a tool which helps us to convert nominal GDP into real GDP as well. Okay, so how we could do? Let us continue the above example. So real GDP is equal to nominal GDP divided by GDP deflator. See, I am just interchanging the things only. Multiply by 100. So will be equal to, from the above example, our nominal GDP turned to be 100,21,000. Our GDP deflator from here is 105 multiplied by 100, which will in turn be equal to, calculate it, and it will turn equal to what we had used, 20,000. So see students, we can reach from A to B, from B to C, from C to B. So our real GDP here turned to be 20,000, and from our above example it was also 20,000 rupees. So thus it means that the value of current year's GDP, that is nominal GDP, when converted into real GDP with the help of GDP deflator, that was 20,000 crore, that turned to be 20,000 crore rupees. Here arises a simple and small question, and we will stop this topic here only. You may be asked a question, let me write down this question for you because it's sort of important. So, can real GDP be greater than nominal GDP? Is it possible that real GDP can be greater than the normal GDP? Dear students, if I have to answer this question, I'll answer it yes. Now you would ask how? Because there are two reasons. Reason number one, when price level in the current year means this year, is lower than that in the base year. Is it a simple thing, or I have to explain it? When price level in the current year, that means this year, is lower than the base year. So it is not possible. It is that a pen was sold for 100 rupees in year 2017. Now in 2020 it will be sold for rupees 80 only. So it is, but this is a case. Can it be? Yes, it can be when the price level of current year is lower than the base year. Second reason for this could be very simple, that when output of final goods and services in the current year is less than that in base year. So now you can relate the two. First is when price level. Second is when output of final goods and services. That output commands a price. That means we are talking of the same thing into which these are the two faces of the same coin. So now this question can be turned upside down, or it can be asked in other way. Can let us say here, can real GDP be, this was greater. Now we can say can be smaller than nominal GDP. We can say no. So opposite of it, when price level in the current year is greater than that in the base year, and second reason will be when output of final goods and services in the current year is more than that in the base year. That is how questions are being asked. That is how tricks are being made, and you people will be now able to answer many more questions from the above base knowledge. So if sometimes if this anything like comes to your mind, or you look for, say, how this real GDP is calculated, maybe this thing comes to your mind. So let me give you a very small and precise formula. Dear students, I'll write it here like real GDP, this is for you people, additional, is equal to nominal GDP. Now you know nominal GDP, the GDP which is calculated on the basis of current year prices, divided by price index. You people know what is price index because you had a full-fledged unit last year in statistics for economics on index numbers only. Multiply by 100. So this is these things must be given there if you have to calculate real GDP. Sometimes, say, if real GDP is 200, okay, and your price index has been given as 110, and you are being asked to calculate any thing above. So nominal GDP or real GDP or price index, if any two are given, the third you can calculate very easily. Say in this example, if I put what I was saying, that let us say this real GDP is this real GDP is 200, and this nominal, we are being asked to calculate this nominal GDP. Let us say we have to look for this nominal GDP, and price index has been given as 110. You know that with base of 100, it is always with base of 100, and 10 means 10% has increased. Okay, it is given as 110. We are being asked to calculate nominal GDP. So it will be very simple now. 200 is equal to nominal GDP has to be calculated, divided by this base year price, that is base price index 110, multiply by 100. And when you take this nominal GDP out, it will turn into 200 into 110 upon that base year, this 100, which will be equal to 001 2 2 1 2 2 2 20 20 rupees 220. So this is one more thing which I would love to say you. So here I am concluding this class. I am signing off, and the next class will be related to the measurement of national income by value added or output or product method. So here I take a leave of yours. God bless you, and God bless us all.